Hi, everyone. Welcome to the second part of our discussion on the savings and investment and financial system chapter. So last time, of course, we went through the very nature of the financial system. We talked about the different players in the system, savers and investors, who they are, what they do. We talked about just the nature of the system. Savers are putting financial capital into the system, to save for retirement, to save for a rainy day, to save for a down payment on a house. Investors, on the other hand, are businesses and entrepreneurs who are bringing financial capital out of the system to use that financial capital to invest in physical capital, to expand business activity in the economy, to grow the economy, to grow productivity, to ultimately increase their standard of living in the long run. And we talked about how a well-functioning financial system is vital for allowing for a healthy level of capital accumulation and, of course, long-run productivity growth. If the financial system locks up and if it doesn't work, that can be extremely detrimental to the economy in the short run and in the long run. We talked about financial markets, bond markets, stock markets. Then, of course, we talked about financial intermediation. And we talked about why financial intermediation is the biggest part of the overall financial system. We talked about the advantages that banks and mutual funds bring to the system and why they're a bigger part of the overall system because of those advantages. Before I go on to the last part of the chapter, I want to talk about one thing that I mentioned last time. I just didn't have time to go through it last time because I didn't want to make that video so long. So we talked about the efficient market hypothesis. We talked about in stock markets, we talked about this idea that stock prices reflect our best guess, society's best guess, on the present discounted value of all expected future dividends that companies will pay. That's what stock prices reflect in the long run as a baseline model for understanding stock prices. I think the efficient market hypothesis is a really good model for understanding stock price movements. But there's, of course, more to it than that. It's not as simple as that, even though that's a really great foundation and a great starting point. The thing I want to talk about briefly is stock bubbles, how bubbles arise, what they are, and kind of how they play out in an economy. So I want to draw a simple diagram here. So I'll go to my screen share, and I'm going to go to my little notepad. So think about this. This is time. This is 1990. And this is some measure of stock prices. This could be the S&P 500, or it could be the Dow Jones Industrial Average. And it doesn't matter. For the purposes of this discussion, either one makes sense. So over the course of the 1990s, what was happening? Two things. Personal computers were, of course, becoming fully integrated into businesses. Personal computers obviously started up a decade prior in the early 80s, but things like this take a while to play out. It's not like they happen overnight. But so by the time we get to 1990, personal computers are becoming kind of fully integrated into businesses, and they're really helping increase productivity. And then, of course, by the time we get to the mid-90s, 94, 95, whatever, the internet starts becoming online. I mean, the internet starts becoming in existence. And it starts becoming widely available. I mean, it was in existence earlier, but it becomes widely available in the mid-90s. And that starts boosting productivity as well. And obviously, the internet has completely transformed society over the past 25 years. So we have two factors that are really working to make businesses more productive. And so what do you see happening? You see stock prices moving like this. Stock prices are moving up in a very healthy, a very rapid manner. So we have what we call fundamental values. Fundamental values are what the stocks are really worth. Fundamental values are truly that present discounted value of all expected future dividends. And so, with the efficient market hypothesis, we think that actual prices were tracking fundamental values. Here, the blue line reflects fundamental values. Okay. And here we get to 2000. 2000 was a big year for me. That's the year that I graduated college. So over the first part of the 90s, we think actual prices were going up in a healthy way because fundamental values were rising, because productivity was increasing for those reasons. But over a 5-year period, once we start to see this really healthy growth, what do you think happens? People start observing this and people start thinking, wow, stocks have really been doing well the last few years. People are making a lot of money in the stock market. And people start thinking, geez, I need to get in on this. I need to start buying more stock to take advantage of all this, stock price appreciation that has taken effect, that has taken place. And people start getting really excited. People start getting emotional. And the thing is, we want economic decisions to be based on kind of a cold calculation, not on emotion. But people start getting emotional in this case, and they get excited. They start wanting to really buy stocks to take advantage of all this money people have been making, to get in on that. And people start, buying more and more and more stock. Demand for stock goes up, 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 up because of this excitement. And as demand for stocks rises, actual prices start going like this. Actual prices start going like this. Now, keep in mind, the economy was still continuing to grow and still continuing to do really well during this period because of those productivity enhancing reasons that I mentioned. Fundamental values are going up, but people just became so excited, actual stock prices were going up even more. Now this is a violation of the efficient market hypothesis. Right down here, when stock prices are moving along with fundamental values, that's great. That's showing that markets are efficient. But when this emotion kicks in, when this excitement kicks in, the efficient market hypothesis kind of fails to hold, at least over this kind of short run period. This distance, you know what this is called? Pause your video, think about it. What is this called? Okay, now unpause, you're back. This is called a bubble. It's called a bubble. This kind of deviation between kind of fundamental values, what the stocks are really worth, and what they're actually selling for. What we have here is also what we call a demand-driven market. It's called a demand-driven market because, it wasn't productivity factors that were driving the market at that point. And productivity factors were driving up the blue line, right? The blue line's not observed. It's real, but it's not observed though. But demand, excitement, that just the drive that people have to want to buy stocks, that's driving up the black line, demand-driven market. There's this famous term that came from like 1997 or 1998. It comes from the Fed chair at the time, Alan Greenspan. He said we're experiencing irrational exuberance. Oh, geez. I don't know how to spell exuberance. Is that right? Go tell your friends that your professor doesn't know how to spell exuberance. That doesn't look right. Anyway, just look that up and figure out the right spelling. Irrational exuberance. Anyway, this is important. This is a bubble. It's a violation of the efficient market hypothesis. This kind of thing happens sometimes in financial markets. It happens sometimes in stock markets, and it happens in other areas. If you go a decade later to 07, 08, we had a housing price bubble. If we had time, we could spend a lot of time as well talking about kind of what caused the housing price bubble and why that happened. But anyway, it's a violation of the efficient market hypothesis. But it happens. These kind of things happen. Eventually, the bubble was burst and prices fell back down, back in line with fundamental values. That eventually the bubble ended. Eventually people realized, oh, the market is kind of too excited now, and eventually that burst, and eventually we got back to normal. But this is kind of like a leading edge of research. You know, why do bubbles happen? What causes them to happen? What factors allow for bubbles to happen? And you know, what causes bubbles to burst? And how do bubbles get back to, how do they get back to normal? How do stock prices get back to you know, to prices that reflect efficient markets, to prices that reflect fundamental values? But anyway, I'm going to stop share. I just wanted to make that point. It's a really important point, so I didn't want to squeeze it into the previous video. I wanted you to know about it. Here, next chapter, when we go and talk about the Great Depression, or here soon when we go to talk about the Great Depression, we'll talk about another bubble that occurred that was a big contributor to the Great Depression. All right, let's go back to screen share. And now we're going to finish up kind of the normal part of chapter where we were. One more little tidbit before we progress into the final segment of the chapter. It is, I want to show you this tidbit. Remember this equation from the GDP chapter, Y equals C plus I plus G. We're going to forget about net exports here. We're just assuming we're in a closed economy. Again, you know, in a later chapter, we come back and talk about an open economy. But you know, the point will not change because we ignore net exports. That won't affect the point. So Y equals C plus I plus G. You can redefine Y minus C minus G to be national savings, or total income, Y, minus everything we spend on consumer goods, minus everything we spend on public goods and services. That's what we define as national savings. And then, of course, savings must equal investment. Oh, this is a typo. Savings equals investment, not savings plus investment. Savings equals investment. Savings is what's going into the system. Investment's what's coming out of the system. In the next segment, we're going to talk about the mechanism that ensures that that equality holds. Okay? But one more tidbit that I want to mention, we can introduce this. We can introduce a negative T and a positive T. We have this same equation, right? S equals Y minus C minus G. It's the same equation that we have before, but we're adding a negative T and a positive T, and that ensures that the equality holds. So taxes are all the money we send to the government. So this part, everything we earn minus everything that we send to the government, minus everything we spend on consumer goods, this is private savings, savings in the private sector. And this, public savings, everything the government brings in and everything the government spends, public savings. So total savings in the economy can be divided into public savings and private savings. And that'll be important. We'll come back in a minute and we'll see why I'm making this point and why that's important. So here, first and foremost, we're talking about the market for loanable funds. This is the final section of the chapter, and this is a really important part of the chapter, the market for loanable funds. Here we're talking about the market for financial capital, the market for money that's being loaned and borrowed in the economy. Make sense? This is all of the savings in the economy. This is all of the investment in the economy. And the two are going to be equal, of course, as we have established before, right? All the money going into the financial system is going to be equal to all the money coming out of the financial system. So here we call this loanable funds. You can also label this axis all the savings in the economy. You can also label it all the investment in the economy. All those things are the same thing. The price mechanism here is the interest rate. And here we're talking about the real interest rate, right? We're not worried about inflation. We're abstracting away to that really important interest rate that matters, the real interest rate. So the supply of loanable funds is upward sloping. The supply comes from savings, right? People who are saving for retirement, people who are saving for a rainy day, whatever, people who are just saving to establish an emergency fund. They're putting money into the system, right? The savings comes from those individuals that we described. Say the savings supply, the supply function is upward sloping. We could talk about that. It's not quite completely obvious and completely straightforward as to why it's upward sloping, but we're going to go with the idea that it's upward sloping, even though it's a little bit more complex than that. So if the interest rate is very low, you might say, geez, I'm not going to save only earning a very low rate of interest. I'm just going to spend my money on a vacation to Hawaii, or better yet, a new super cool guitar. But if the interest rate gets higher and higher and higher, you might say, wow, I can really earn a lot of my money. I'm going to just put off that Hawaiian vacation, or I'm just going to put off that super cool guitar, and I'm going to save my money because I can earn so much money in interest by putting my money into the financial system. Does that make sense? I mean, I think it should be intuitive that this savings supply function is upward sloping. On the flip side, the demand function comes from investors. The demand function comes from businesses and entrepreneurs who are trying to acquire financial capital to use that money to expand their business, to grow their business, to start their business, whatever. It's downward sloping. That should be intuitive as well. If the interest rate's really high, then you're going to be spending a lot of money to acquire that financial capital. It's less likely that your business is going to make a profit if you're spending all this money on interest. As that interest rate falls lower and lower and lower, your business prospects look stronger and stronger because you are eliminating that interest expense, and therefore you're more likely to take the plunge, engage in the investment. Quantity demanded rises. Should be intuitive. I mean, if that doesn't sound intuitive, then I'm not explaining it well, because the upward sloping nature of the supply curve, the downward sloping nature of the demand curve should both be totally intuitive. The equilibrium in the market works out, just as always, right? I mean, if the interest rate's too high, there's going to be an excess supply. That won't be stable. There will be a natural tendency for the interest rate to fall. If the interest rate's too low, same thing. There'll be an excess demand. That won't be stable. There'll be a natural tendency for the interest rate to rise, just until we reach that equilibrium where quantity demanded is just equal to quantity supplied. There's no more pressure for the interest rate, or the price. The interest rate is the price. There's no more pressure for the price mechanism to move, and we have a stable point. We have an equilibrium. So that's kind of how this works, right? We say that savings equals investment, right? We say that the money going into the financial system is equal to the money going out of the financial system. But savings and investment are two completely different things, right? How much money people are wanting to save for retirement, or for a mortgage pay, or for a mortgage down payment, or for whatever, that's completely different than how much money businesses are wanting to acquire from the financial system to expand or grow their business. That's two completely different functions, but it's the interest rate that moves to make sure that the two are in equilibrium. Make sense? Now here, we're going to talk about a savings incentive. Obviously, a higher interest rate makes people want to save more, right? We've already said that, but that's embedded within the nature of the supply curve. We're talking about an incentive that makes people more inclined to save at any given rate of interest. Something that shifts that whole curve, making people more inclined to save at any given rate of interest. Here are some examples of savings incentives. I'm not going to talk through all these. I would encourage you to just read the book and understand what the book says about, what makes people more inclined or less inclined to save at any given rate of interest. But here's kind of a few examples. One is this, we pay taxes on interest income, but if you have money in the bank and if you earn interest on that money, or if you have money in bonds and if you earn interest on that money, then you have to pay taxes on that money. And if we were to cut that tax rate, you don't have to give up as much of your return to the government, so you'd probably be more inclined to save, right? So a cut in the tax rate on interest income, or a cut in the tax rate on stock dividends, it's the same idea. If you're earning dividends from stocks, you have to pay part of that money to the government in the form of taxes. If that tax rate is cut, same thing goes on capital gains as well. If you make capital gains on stocks or bonds, you have to pay part of that to the government in the form of taxes. So a tax rate on any of those things is going to make people more inclined to save, and it's going to shift the supply curve in that fashion. It's going to increase supply. It's going to be an example of a savings incentive. How about this? 401k accounts. Normally we have income taxes in this country, right? We're talking about the federal government, right? State governments and local governments operate differently. But for the federal government, the federal government relies most heavily on income taxes. And as we just said, you have to pay income taxes on those forms of capital income as well: interest, dividends, capital gains. But so we mostly have an income-based tax system. But the exception to that, or one exception to that, is 401k account. 401k account allows you to put part of your income into this account, and you don't have to pay taxes on that income until you withdraw the money years down the road after you've retired. So you can save money, up to a certain amount per year. The amount right now, I don't know, I haven't looked up the exact amount, but right now the threshold is about somewhere between $15,000 and $20,000 a year. You can save that much money in your 401k, and you can save the money on a pre-tax basis. You don't pay taxes on the money until you withdraw it when you're 60, 70, 80 years old. That's an exception to some extent to our income-based tax system. And now, I'm not going to go through this. This is not a personal finance class, but the existence of 401k accounts, right? The fact that you don't have to pay money on that, the fact that you don't have to pay taxes on that money until you retire, that's a big savings incentive, right? The existence of 401k accounts is another example of a savings incentive, or an expansion of the 401k account would be an example of a savings incentive, right? If we were to raise the threshold from $15,000 or $20,000 to somewhere between $20,000 and $25,000, that would be a savings incentive. So either way, the existence of the account in the general sense or an expansion of the account are both examples of savings incentives. Do you know where the term 401k comes from? Well, this provision is stated in section 401, paragraph K of the IRS code. That's where it comes from. That's where it's described. Section 401, paragraph K. It's very tedious to read through all this stuff. Imagine reading through 401 sections of IRS code. Talk about being suicidal, you would be. But anyway, that's where it comes from. 403B accounts are the same thing, except they are for workers who work for government or nonprofits. 401k accounts are for private sector workers. There's no difference between the two. It's just a technicality that's within the IRS code. Anyway, those are examples of savings incentives. So if we provide a savings incentive, this is what happens, right? If we engage in any of those types of activities that make people more inclined to save at any given interest rate, then it's going to shift the supply curve to the right. Right? The market will be thrust into a disequilibrium initially. That'll cause the interest rate to fall, and we'll wind up with a higher quantity of savings and investment. Does that make sense? Right? What's the point of this? Right? Don't lose track of where we are. Don't lose track of why we're talking about this. The reason this matters is because this gives us more investment, therefore more capital accumulation, therefore it helps make the economy more productive over the long run. Remember, back to that long run economic growth chapter that started off this section. Physical capital is a key determinant of productivity. This is a policy that we could pursue that could allow us to accumulate more capital, grow productivity faster, and ultimately lead to a higher standard of living in the long run. Okay? Here's a question I have for you. Let's discuss this in the Zoom meeting on Monday. Why don't we just do this to the full extent possible? Why don't we just do this to the full extent possible if what I'm presenting to you is the positive, right? This is the positive on, this is the good thing about a savings incentive. A savings incentive makes people more inclined to save. We get more capital accumulation, more productivity. So why don't we go back to these policies and just like pursue them to the fullest extent? What's the downside? In other words, what I'm asking is, what's the downside with this? Well, I'm not going to tell you right now. You think about it, you simmer on it, you'll find that this is a really interesting question, because there's positives, as we just said, and there's negatives, and it makes for a very interesting discussion. Okay? On the flip side, an investment incentive. An investment incentive is something that makes people more inclined to borrow money, to acquire financial capital, to invest in physical capital. Something that makes businesses and entrepreneurs more inclined to borrow money to invest. Shifts demand to the right, and you see how that works. Here's some examples of an investment incentive. We have something called an investment tax credit. The federal government actually doesn't have an investment tax credit per se anymore. They used to have one, it went away, but there's always kind of a perpetual discussion over an investment tax credit. An investment tax credit is a policy that gives a business a tax break if it invests in certain capital assets. It's just a policy that just specifically encourages businesses to do this. It encourages businesses to become more inclined to invest by giving them a tax break, and it's something that shifts that supply curve to the right. So you all are in Frank's class as well right now. We don't have much time in this class. I'm really trying hard not to keep these videos too grueling, so go ask Frank what accelerated depreciation is. That's an accounting issue. Frank can help talk you through what accelerated depreciation is if you wish, and that's another example of an investment incentive. Hey, maybe Frank would be mad at me for putting some of my workload on him, but hey, we're working from home now, so I don't run into him in the hall, so too bad. He can't grab me in the hall and say, hey, why are you having me explain accelerated depreciation when you're supposed to explain it? Anyway, this is what an investment incentive does. Same idea, right? It shifts demand to the right. It makes people more inclined to invest at any given interest rate. That will put the economy, that'll put the financial system into a disequilibrium. It'll cause interest rates to rise, ultimately leading to an increase in the quantity of savings and investment. Right? So a savings incentive causes interest rates to fall. An investment incentive causes interest rates to rise. But that doesn't matter, right? We don't care what happens to interest rates. That's not the point. The point is both policies cause the quantity of savings and investment to rise, and that's what we're trying to achieve. We're trying to get more investment, more capital accumulation. That's what leads to that productivity growth in the long run. The last example, government budget deficit. You know, we're always talking about the government budget deficit. We're always concerned about the government budget deficit. You know, just in general, the deficit is the fact that the government typically spends more than it brings in tax revenue. Here lately, especially since the crisis has emerged this year, the budget deficit has gone through the roof. We are spending way, way, way more than we're bringing in tax revenue. So that's what the deficit is. But this is the point. The government borrowing crowds out savings in the private sector. So that supply curve, you know, I say that supply curve is savings going into the financial system. But what I didn't mention is in that picture, we're talking about private sector savings and investment. That picture ignores government. That picture ignores the public sector. I didn't mention that before, but now I'm just telling you to kind of complete the story. So when the government runs a deficit, when the government comes into the economy and borrows a whole bunch of money, that just means that there's less money left over to be saved in the private sector. And this is what happens, right? If the government's borrowing all that money, then the result is there's not as much money left to be saved into the private sector. That supply curve shifts to the left. That reduction in supply that we're talking about is referred to as crowding out. You see that in the previous slide, right? Crowds out. That's referred to as crowding out. The public sector activity crowds out the private sector activity. Government budget deficit causes supply in the private sector to fall. That causes interest rates to rise. That causes the quantity of savings and investment to fall. That's a bad thing because that leads to less capital accumulation, less productivity growth in the private sector. That's a problem. That's why you frequently hear kind of lip service about, hey, let's get the government budget deficit down. Let's reduce this deficit. Let's find a way to cut down on this government, budgetary hole. Here's another discussion question for us. If the government budget deficit is so bad because it crowds out savings and investment in the private sector, then why do we always have a budget deficit? The last time we didn't have a budget deficit was 20 years ago. 1999, 2000, we actually had a government budget surplus. And even that was very rare. If you go back to the end of if you go back to the Civil War, the number of years that we've had, a balanced budget or a surplus is at most 1 in 10. At least 90% of the time, we're running a government budget deficit, despite this problem here. So my question for you is, why is that the case? What's going on with their tax system? What's going on with their overall, government structure, with tax system and with spending on the flip side? What's going on there that we just can't seem to get that budget deficit to go down or to disappear? And why can't we get that supply curve to come back to the right, to eliminate that crowding out, to encourage more, capital accumulation in the private sector? That's a good discussion question. There's a lot of things we can say there. So that's it. Remember this model, this market for loanable funds model can be used in so many cases. There's a lot of examples you can think about when you think about the supply and demand for loanable funds, the supply and demand for financial capital, and how various shocks affect ultimately the quantity of savings and investment in the economy. So that's it. Thank you all. Talk to you soon.